Let's elaborate a little bit on private credit. I think people probably have heard that term before. I've had a couple of people who've come on and they're kind of more investors in that space, but we didn't really get into like what exactly is private credit?
Yeah, it's a bit of a catch-all, actually. So you have private capital markets as a whole, which is not your traditional public stocks, bonds, et cetera. So within private capital markets, it's a wide mix. You have private equity, you have venture capital, you have real estate, infrastructure, and then you have this catch-all called private credit. And so private credit encompasses a variety of different things, but think of it as like small business lending, consumer loans, factor receivables, all these things that are just in kind of like the lending space that are smaller dollar. It's really what encompasses private credit, but it touches every single thing that you do on a day-to-day basis. Like that example I gave you earlier for that lender to granola bar companies. I mean, the stuff you see at Whole Foods, pretty much like all of them have gone through some sort of private credit transaction to even get that onto the shelf if they're not Kashi or something like that. And so that's really where it's a tremendous opportunity. It's a massive market. It's growing at about, I think, a 20% compound annual growth rate since 2000. It picked up during 0809 when the banks stopped lending to the side of the business. It's definitely picked up during COVID when the banks extra stopped lending to the side of the market. So that's been one that's been an area of significant growth. But like I mentioned earlier, the transparency part is a huge problem. So of that $1 trillion, about 400 billion is sitting in cash, waiting to find deals, deploy into deals if they can literally just have a solution for them. And that's really where we come in.
Got it. And so the people who are offering these opportunities, you mentioned small businesses. Maybe just talk a little bit about, kind of who's taking on the debt and kind of what types of businesses are they in? Why are they coming to this side of the market rather than maybe pursuing other types of capital financing? Just elaborate a little bit on that.
Yeah, sure. So if you kind of go up the chain here, so the small business itself generally needs capital to grow. It's pretty standard. It can be backed by, it could be a secured loan, it could be an unsecured loan. If it's a secured loan, it's usually off of like a personal guarantee of the founder of the company, or it's like their house or something like that. If it's unsecured, it's just based off of the revenue that they're projected to receive coming up over the next couple of months. So these businesses on a regular basis need to take a loan out to be able to have working capital when things take longer to pay out and things like that. So they usually go online, they Google it because their bank probably won't lend to them at this point these days. And they find the various different, most of them are fintech companies actually, who kind of cover this space, your OnDeck, your Cabbages, and things like that on the small business side. So they go to them and they say, hey, I need a loan for X dollars. This is my financials. This is how I've done over the last couple of years. How much can you give me? And the lender looks at their client prospective borrower and says, okay, I can give you this amount and let's call it a day. What people don't know is that the lender itself actually needs to get money themselves as well to lend out. And that's really where this entire private credit market is coming from. So the lenders themselves source capital from a variety of different places. It could be hedge funds, it could be credit funds, it could be family offices, or even, when they're really small, they're actually lending off their own balance sheet. So a lot of fintech startups were backed by VCs to get off the ground. They are their first source of capital. It's very, very expensive. So the ecosystem that we're helping facilitate is basically getting the lenders the most probably flexible, cheapest cost of capital they can get and provide it at every single phase of their growth. Because the lenders ideally grow from being a small lender to a mid-sized lender to ultimately one that the banks can be the ones providing capital. And that's really the holy grail because it is the cheapest they can get.